going to show you example, a few questions on the share-based payment. As at year end 31st December year 8, an entity grant 100 shares, 100 shares to 50 employees. So this is the share option. So the employees are entitled to the shares immediately with no consideration to be paid, meaning that the company will issue shares to the employee for free. Okay, the employee doesn't have to pay for the shares. So this grant was made on 31st December 18. However, the share will only be issued on 1st February 2009. So you will issue the share here. But this is the grant date. Okay. The market value on this day, on the grant date, is RM 4 ringgit. So what is the journal entry for 31st December 18 when you want to recognize the stock option, the stock, okay? And then on 1st February when you actually issue the share. So at grant date, that will be an expenses to the company. So you debit employee benefit expenses. I will credit the reserve, which is equity component. So 50 employees times 100 shares times the price of the share. And when you actually issue the share, you will credit the share capital. It will increase the capital of the company, and you will reverse back the reserve that you have credited here. So when this is actually the settlement. Okay, the settlement. So you will debit the reserve and you will credit the capital. So that's one example. As at year end 31st December 8, an entity grant 100 shares to 50 employees. Okay, we have the same number of shares, same number of employees. And these employees are required to be under the employment of the entity for 2 years from the grant date. So meaning that this is a service condition whereby the employees are entitled to the grant only when they completed the 2 years. The shares will be issued to the employees on 1st January 2011. So the grant date is on 31st December 8. Okay, so for 2 years, you have 9 and then 10. So on 1st January 11 is the settlement. Alright, so it is highly probable that all the 50 employees will remain with the entity. Meaning that when you settle, all the 50 employees actually completed the 2 years. So when you calculate for year 9, year 10 and the settlement. So in year 9, it will be the total number of employees entitled to receive the grant times 100 shares times the share price 4 ringgit times 1/2 because it takes 2 years. The vetting period is 2 years. So the first portion is 1/2, the second portion is 2/2. But you don't have to show the calculation because the variable that you use to compute does not change. Okay, the same employee at the same number of share and at the same price. So you just calculate it once. That means 10,000 for each year. So when you settle, this is the settlement date. You will credit your share capital because you issue shares. I will debit back the reserve. The total 20,000. This is accumulate 10,000 plus 10,000. So it is a 20,000 reserve. You reverse it back. Okay, next example. As at year end 31st December year 8, an entity grant. Okay, 31st December year 8, the company grant 100 shares to 50 employees. The employees are entitled to the shares immediately with no consideration to be paid. On the grant date, the market value of the share is RM4. and the nominal value of the share is 1 ringgit. The 50 employees are required to be under employment for 3 years. So that will be year 9, year 10 and year 11. Okay, 3 years. The share will be issued to the employees on 1st January 12. The entity estimate that 10% of the employee will leave before the vesting date. That means not all 50 employees will entitle. It is only 90% entitled on the settlement date. Okay, so when you calculate for each year, 2009, 10, 11, okay, it is basically, okay, this is just an option, okay, 100 shares to 50 employees, but because only 10% will leave, that means leaving only 90% here, times the share price, times the first portion of the vesting period, the first year, so 1/3. And the same number of expenses incurred for that year, okay, for 3 years. For 3 years, 6,000, 6,000. But the reserve accumulate 6, okay, 6 plus 6 and another 6 the first year. So that means 18,000. So you will debit your reserve. This is the settlement date. So you will debit 18,000. Okay, this one now saya lupa padam. Now we don't have the par value anymore. Okay, we are not talking about par value. So this one times with 4. Okay, you don't have to split this one. It is actually 18,000 because we don't have par value under the new Companies Act. Okay, right, that's done. Okay, this is a vesting condition. Okay, it's a long question here. The entity grant 50 employees in the sales department an option to buy 100 shares each. Okay, that will be 1st January year 1. 50 employees, 100 shares. The fair value of the option is RM4 ringgit. Okay, that will be on RM4 ringgit. That will be in the first year lah, sini RM4. So this is actually a performance condition. Okay, if you refer back to the vesting is whereby the counterpart, the employee basically will need to perform certain things before they will actually obtain the option, the share option. So this is a performance option, condition whereby if sales for the year increase by 15%, okay, if sales increase by 15%, the option will increase by 10%. So kalau sales increase 15%, the option will increase by 10%. And if the sales increase by 25%, then the option will increase by 15%. Okay, the vesting period is 3 years. So that will be 31st December year 1, year 2, year 3. So that is 3 years. And then they estimate that 10% of the employee will leave before the end of the vesting period. So this is estimated percentage, the employee leaving the company. So this employee are not entitled for the option, for the grant. Okay, so when we calculate, okay, in year 1, the sales for the year are 10% higher. So it is not entitled for the performance condition because it is below 15%. Alright, and 3 employees leave the sales department. Okay, this is the actual leaving the company. Now, earlier on we estimate 10% leaving the company. But this is the actual figure in year 1. In year 2, the entity estimate that sale will increase by 20%. It reached that 15%. Therefore, in the second year, the option you will times with 1.1. Okay, because it increased by 10%. And only 45 employees will remain in the sale. This is the estimate, the new estimate. Okay, the estimate. In the third year, 26% higher than year 2 sales. So 26% reach this condition, 25%. So in this third year, you will time with 1.5. And another 3 employee leaves the department.
It's 11 o'clock.
Okay. Now when you compute for each year, let's look the first one. The first year, you did not achieve the performance condition. So, the number of share times the 50 employees and the estimated employee left in the company, because earlier on you estimate 10% will leave the company. So, you times with 90%, times with the share price, times with 1/3 because the vesting period is 3 years. So, you get 6,000 expenses and the equity is 6,000. In the second year, alright, you achieve the performance condition, so you times with 1.1 because the option increased by 10%. So times with 1.1. Okay, 1.1, and then times with the same price, 4 ringgit. This is 2/3. Okay, but this time you times with 45 employees. Because in the second year, it says that only 45 employees would remain. This is the estimation. See? Alright, so we take the estimation, 45 employees. In the third year, 100 shares, and we times with 1.15 because we achieve the 25% performance condition. So we times with 1.5 and the same share price times the third year, so 3/3, times with 44 employees. So how do we get these 44 employees? The third year, which is the final year of the vesting period, you should take the actual employee left in the company. So the original figure, the original number of employee is 50. So you will minus with 6. So how do you get 6? 6, the first year, the actual employee leave the company is 3. Okay, and then second year, none. And the third year, another 3 leave the company. So this is the actual number. This is also actual number. So we minus the actual. Remember, the final year of the vesting period, we need to take the actual, not the estimated employee left in the company. It must be the actual number of employee left stay. Okay, the actual number of employees stay in the company. The first year we take the estimation, it says 90%. Okay, even though the question gave you the first year 3 left, but we will take the estimation. Second year, the estimated number of employee given is 45 employees. So we just take the 45 employee. But the third year, the final vesting period, we will take the actual number of employee that still remain in the company. So that's why we take 44. So this one, expenses incur every year. Remember, because the calculation here, there are certain variable that change. In this case, alright, for the second year, you have to times with 1.1. So the variable in the computation has changed. That's why you have to minus the 6,000 here. Okay, as compared to the previous calculation, you only calculate it once because the variable used to calculate the expenses is same every year. So you get the same figure 6,000 every year. But for this question, the variable to compute the item, to compute the expenses is different. For the first year, it's only 100 share, but the second year, it is 110 shares. So it's different. That's why when you compute the second year, you have to minus the first year so that you get expenses for the first year, for the second year. And same goes in the third year. You calculate the third year, you get this reserve, and you minus the 2 portion here, right? 13,200. So you get the expenses for the third year. Okay. Alright, this is another example. As at year end 31st December year 8, entity grants. Okay, 31st December year 8. The entity grant 100 shares to 50 employees on condition that they stay with the entity for 3 years. So you have year 9, year 10 until year 11. They have to stay in the company. The option can only be exercised if the share price has increased to 15 ringgit per share by the end of the third year. So if only the share price reach 15 ringgit, then they will get these shares. Okay, the employee will get these shares. Alright. So the fair value of the option is determined as 6 ringgit after taking into consideration the potential increase of the share price to 15 ringgit. So this 6 ringgit has taken into account whether or not the share price will increase 15 ringgit. Okay, so it is highly probable that all employees would remain with the entity. That means you have just time with 50 employees. So you need to calculate for the 3 years. So the number of shares times with all 50 employees times with the price that has already been adjusted with the market condition, and times with the portion, the first portion, and then you minus. Okay, this is actually every year we get the same thing. You don't have to calculate because the variable used here is actually the same. See, times 1/3, and this one it doesn't change. So you don't have to do this computation. You can simply compute 100 times 50 times 6 times 1/3, and you'll get 10,000, and 10,000 for each year. And that equity will accumulate. First year 10,000, the second year 10 plus 10, 10 here plus previous year 10, you get 20, 10 plus 20, you get 30. Okay, you don't have to do this minus part because the variable, like I said, because the variable used to compute is same every year. Unless there is a changes in the share price, or there is a changes in the number of employee, or there is a changes in the number of share, then only you use this kind of calculation where you minus the first year or the first and the second year. Okay, but if you want to do this calculation is also okay, but it will take more time lah. Alright, this is another example. As at year end 31st December year 8, BBA Berhad grant 100 shares. Okay, 31st December year 8, okay, you grant 100 shares to 50 employees. The employees are required to be under the employment of the entity for 3 years. So that means year 9, year 10 and year 11. The shares will be issued on 1st January 12. Okay, you will issue the share. This is the exercise take place, or the settlement take place. BBA estimate that 10% of the employee would leave the company. So 10%, meaning 90% will remain in the company. But it is unable to estimate the fair value of the option on the grant date. You do not know what is the share price here. Okay, so what you need to do, you need to use the intrinsic value. What is intrinsic value? Intrinsic value is the share price less the exercise price. Okay. Alright. So now you estimate that 10% will leave the company. Okay, and then the exercise price is 10 ringgit and the average share price in year 10 is RM10. Okay, so here is RM10, the price, the average price, and then 6 employees leave the company in year 11. Year 11, so this is the actual number of employee left, 6 left. Should I say 6? Leave lah. Nanti ingatkan yang tinggal sahaja. 6 leave the company. Okay, 6 leave the company. BBA financial year ends on 31st December each year and the share price 2009 until 11 given. So here is 12, here is 15, and year 11 is 15 RM. Okay. So you need to use the intrinsic value to compute the expenses for each year. Alright, so the first year, 100 shares issued to 50 employees, but because you estimate 10% leaving, so only time with 90%. So the share price in year 9 minus the exercise price times with the first year portion. So you get 3,000. The second year, 100 share given to 50 employees times with 90% times with the share price in 2010, 15 minus the exercise price, same the second year portion minus the first year expenses. So you get 3,000. You get 12,000. In the third year you identify the actual employee leave the company 6, so 50 minus 6 you have 44. Okay, 50 minus 6 actual leaving the company, left with 44 employees, and the price in year 11 minus the exercise price and the third, and minus the previous expenses, previous reserve lah. So you get 7,000. Okay, so you get 7040. Apa ni? Okay, this one 7,000, yeah. Alright, so in the end, meaning that your equity accumulate up to the end of the vesting period, the equity is now 22,000. So that's the calculation. Alright, next, this is event after vesting date. That means whether or not the company able to exercise the share-based payment. Okay, during the vesting period, you have recognized this. This is a recognition. So you pass the entry, debit the expenses, and you credit the reserve. But after the vesting date, you identify that none of the employee are entitled for the benefit. So what you do is, you don't have to pay them or issue the shares. So what you do, you cancel off the reserve, you debit the reserve, and you will transfer that into the retained earning. Okay. Okay, this is recognition as well. This has been explained in the previous videos under the PowerPoint slide. Okay, complex transaction is about the choice, who has the choice to pay, either the entity or the counterpart. Right, now look at the example. 30th June, year 7, BBA purchased a building for 5 million. Okay, year 30th June, year 7. So you purchase a building, so this is asset for 5 million. So this is the fair value of the goods, of the good services received, 5 million. the seller has agreed to accept payment for the building either. So option is given to the counterparty. This is, seller is the counterparty. So if it is a counterparty, remember the company effectively issue a compound instrument, whereby you need to identify what is the equity component. So the choice is either 1.5 million shares, okay, to be issued in 6 months time, or to receive cash to be paid in 3 months, which is equivalent to 1.3 million shares. It is estimated that the share price will be 3.60 ringgit in 3 months time and 4 ringgit in 6 months time. The price of the shares on 30th June 7 was RM3. Okay. Determine the value of the equity component. So how do you compute? This is the formula, the fair value, because you are recognizing the asset at the fair value of the goods service received, which is the fair value of the building. Therefore, when you identify the equity component, it will be the fair value of the building, which is 5 million. And you minus the fair value of the liability, which is 3 ringgit times 1.3. Okay, this is the date. We assume when you purchase, this is the date you receive the building, definitely, okay, because building is not delivered to you. Alright, so this is the date you receive, you obtain the asset, therefore 1.3 times 3. So this is the equity component. Alright, if you were asked to prepare journal entry, it will be debit building 5 million. Okay, it is measured at the fair value of the asset. You will credit the liability component and you will debit the equity component. So the equity component here is 1.1 million. Okay, here is 3.9. This is transaction with employees. On 31st May year 7, you grant one of the director the right to choose either. So this is also counterparty has the right to choose. So again, the company effectively issue a compound instrument. So either they will receive 40,000 shares or cash that is equivalent to 30,000 shares at the market value. Okay, the settlement date is 1st July 18, 1st July year 8. The company estimate the fair value of the share alternative is 2 ringgit 50 cents. So this is share alternative. So this is 2 ringgit 50 cents. On 31st May year 7, we have to take this date, okay, because this is the date where you grant the share-based scheme. Okay, and then the company share price at 31st May year 7 was RM 3 ringgit 20 cent. On this date, the share price is 3 ringgit 20 cent. When you want to measure the cash settle, it will be equivalent to the market value of the shares on that date. So that will be 30,000 times 3 ringgit 20 cent. So when you compute the equity component, alright, so this is a cash settle. So fair value of equity settle alternative, they were 2 ringgit 50 cent times 40,000. This one, given in the question, that 250 is for the share alternative. So you times with that. And then the fair value of the cash settle alternative will be 3 ringgit 20 cent. We take this price on this date, the grant date, 3.20 cent times 30,000. So now the equity component is 4,000. Okay, so in this case, This one, if you were asked to prepare the journal entry, so you will debit the employee benefit expenses. You credit the liability. And you credit the equity component. Okay, so the equity component is 4,000. This one, how much? 2.5 times 40. 2.5 times 40. 100. So this is 100,000, is it? Okay, so the balance is, takkanlah, 2.5 times 40,000. That is 100,000, yes. So 3.2 times 30,000. That is 96. Yang ini is 4,000, betul lah. So this is 96. Okay. Alright. So is that all? Okay, that's for the computation part. So the disclosure here, I have explained it in the previous video. That's all. Thank you.